I've got to sound a little bit like I told you so on the bond thing. There just aren't enough institutions investing in early stage science and technology in the UK. It's an own goal whose sort of gestation really is the government's policy on drug pricing. The UK economy is over-regulated and suffers from poor regulation. We are burdened with ludicrous regulation, which throttles the economy.
Welcome back to W4.0's Roundup of the Week. I'm here with Neil Woodford to talk through the stories and the themes that have shaped markets over the past few days. We'll be looking at Merck's decision to pull the plug on a £1 billion research centre in London, upcoming central bank rate decisions, China's stimulus measures, and Larry Ellison's record-breaking wealth gain. Plenty to cover, Neil, so let's get started. But just before we do, last week, bond yields were all anyone could talk about. But they've largely drifted back to where they were before the headlines and the panic. I think finally starting to make sense again.
I think the markets are sort of calming down a bit. I have no doubt that we'll have many more episodes of widespread panic, rather like we had last week. But I think what's important is that it is really that the investors resist the temptation to be influenced by market madness, because that's what it is. I mean, it was really interesting last week. Everybody was talking about the 30-year gilt yield. Everybody was very worried about the impact this would have on, or that this was a reflection of some sort of bond buyers strike, and that we're all going to the IMF, and the world's ending. We're going to hell in a handcart. It was total rubbish. What got missed in all that, I did mention it last week, is that the head of the Bank of England said that the UK Debt Management Office wouldn't be issuing any 30-year gilts, but that obviously doesn't fit with the narrative, and so nobody really focused on it. I obviously mentioned it last week on this podcast, but it didn't get a mention in the media. Now look, bond yields have settled back to where they were. The 30-year yield is back to where it was back in January this year, and the 10-year yield, although still a little bit higher than I would like, is at just over 4.6%. And yields in the US have come down this week, or over the last week or so, largely because the job data was weaker than I had thought it would be, and weaker than the market was expecting. And as a result, I think there is now an absolute certainty that rates will be cut next week in the US, and quite a few people are now saying it will be a 50 basis points cut than the 25. So the fact is that, as I said last week, as I've said consistently through this year, interest rates are headed down, bond yields are headed down, and please ignore the hysterical nonsense that seems to obsess markets periodically.
Neil, let's stick with central bank rate cuts. You said at the start of the year that was going to be one of the big themes of 2025, and that has certainly proved true so far. We've got big decisions coming up Friday this week and next week. How are you looking at those decisions, and what is most important for our listeners to focus on?
The most important decisions really are those that are made in the US. The US is the sort of benchmark for global bond yields, really. In some respects, the link, for example, to Chinese 10 years, the 10-year yield in the euro market is less rigid, if you like. There has traditionally been a very close relationship between 10-year yields in the US and 10-year yields in the UK, for example, and really the global bond market benchmark is set by US yields. So what happens there is very important, and it ripples across global bond markets whenever there's a change, or whenever there's a data set that changes the market's expectations. Now, in recent days, and in recent weeks indeed, we've seen very clear evidence that the US labour market is weakening. It's significantly weaker than the consensus had expected. Now, remember, going back to April, the sort of the consensus view was Trump's tariffs would lead to a significant increase in inflation, and this would stop the Fed from cutting rates. Indeed, there were some who were arguing that rates would rise in the US. The inflationary impacts of Trump's tariffs are much more muted than the consensus believed back then. There still really isn't that much evidence of that inflation coming through in reported inflation. I think in the real economy, there are impacts that can be seen, but they have yet to manifest themselves in headline inflation rates. So it's clear to me that the Fed now has, I think, the confidence, not least because of what I've said is happening in the bond in the labor market, to cut rates, and I think they'll get on with it now. So I think there'll be a cut next week. And there may well be I think there will be further cuts before the year end. Now, that sets an important precedent, obviously, for the UK monetary authorities. The Bank of England has been a reluctant cutter of rates this year, I think mistakenly. There's a whole load of nonsense talked about amongst the committee members about the non-inflationary rate of interest, all sorts of nonsense about capacity utilization. The fact is, inflation in the UK is higher than it would otherwise have been because of the measures that were introduced in the budget. A lot of administered inflation has pushed the headline rate up in the UK, but those effects are one-off. What's much more important in the UK is what's happening in the labour market, which is weakening as well, and importantly, what's also happening in terms of wage settlement. So they've come back from basically about 6% at the start of the year now to about 3%. So this is very important for inflation going forward. So although we won't see a rate cut in the UK just yet, I'm very confident that we'll see a cut in November. And rates will carry on falling in the UK as inflation subsides and returns back to the Bank of England's target of 2% next year. So rates are coming down in the UK. Bond yields will come down in the UK as they will in the US. I think the sort of trajectory is clear.
And you've been vocal about what you think about valuations in the US, particularly the big tech stocks and the Mag 7. Do you think policy moves in the next few weeks could change much of that picture?
Not really, no. The US market has bounced back very, very strongly from the lows that it reached in early April, just as the UK market has. But there's been a strong bounce back in the US equity market. The S&P still is behind the gain in the FTSE 100 this year, and I think just marginally behind the gain in Euro stocks. Certainly behind China, which has led the world's equity markets. Pretty much exactly what I said at the start of the year. So look, I don't expect lower rates to have a major impact on the headline valuation arguments for those Mag 7 stocks or indeed the stocks in and around the Mag 7. But what I do think is that lower rates do have important implications for the substrata, if you like, of the US equity market. The economy, the stocks in the US equity market that are geared into activity in the UK in the US economy, if you like, the US equivalent of our sort of mid and small cap, effectively, those companies are likely. There is a strong argument, frankly, that lower rates should impact the valuation of those businesses. And frankly, it is in that small and mid cap space that I've said consistently there is more valuation attraction in the US market. So to some extent, I think lower rates is good news for that part of the market where I think there are more interesting valuation opportunities. But I don't think lower rates sort of directly lead to higher valuation multiples in the very sort of well-owned, very sort of highly regarded, strong growth tech sector.
Now, another story that's stirred up some concern this week in the UK is Merck cancelling its planned billion research centre in London. And the company pointed to government policy and undervaluation of innovative medicines. Given the government often talks about life science being a crown jewel in the UK economy, how significant is this pullout for the UK?
Look, I think it is a significant and worrying decision. And so let me sort of put that comment into context. I wrote recently in a note that's called The Self-Loathing Economy, why I think the outlook for the UK economy is much better than consensus believes in the short to medium term. And I absolutely stand by that view. And indeed, I provided evidence to support that view in the note. But at the end of the note, I talked about some of the things that worry me about the longer term outlook for the UK economy. And although I haven't written that note yet, this decision by Merck speaks to one of the concerns I have about that longer term economic outlook. And that's in this specific example, this decision by Merck is a manifestation of, I think, of the government's neglect and the UK economy's broad neglect of the knowledge economy industries, which are going to be the engines of growth for this economy going forward. I've long argued that the government, that there was market failure, frankly, in the financing of technology in the UK. There just aren't enough institutions investing in early stage science and technology in the UK. That market failure has been highlighted by myself and others and requires action. And I felt and do still feel that the government needs to step in to first recognize that there's market failure and then to do something about that market failure. I think there's more that it can do, a lot more it can do. But this decision by Merck is specifically, I think, a reflection of the neglect, frankly, that the government policy and the NHS's policy, particularly with respect to drug pricing, and has had NICE's impact effectively on the UK's drug market.
So this is becoming a systemic problem.
Yes, it is. I mean, this is not the first decision. I mean, AstraZeneca, a homegrown pharmaceutical champion, decided a few months ago to cancel a big vaccine manufacturing project in near Liverpool, and now we've got Merck cancelling a big investment in London. These companies don't take these decisions lightly. These are big, long-term strategic decisions, and they've taken them because the UK is becoming less and less attractive for this sort of inward investment by major pharmaceutical companies, and they're instead going to invest, I would imagine, in the US, which is creating the right sort of environment for this type of investment. So, lots of people may be attracted to the idea. It's great that NICE keep a lid on new drug prices, that we've got this sort of controlling mechanism on drug pricing in the UK. And to some extent, yes, I accept that there are the government or the NHS uses its buying power to exert or to extract good terms from pharmaceutical companies on drug pricing, but this is not a one-way street. And what we're now seeing is that if drug companies can't get their latest treatments into patients in the UK, we can't, and they're not able to take advantage of the market opportunity in the UK, they won't invest here, and they'll look to other economies to invest where they can grow and achieve an attractive economic return. So this is not a one-way street. I think the debate about this whole thing about drug pricing has been very one-sided, lopsided in the UK. There are costs and risks associated with what NICE is doing.
Well, and your point about the UK sort of missing out, Merck are still going to go ahead with this research centre, presumably. It just won't be in the UK.
It won't be in the UK, no. So not only will their investment go into another economy somewhere else, but that investment will attract skilled people, talent, Maybe some UK talent, homegrown talent, will move abroad to get the highly paid, attractive jobs in the industry that are going to grow elsewhere.
And the knock-on effect of the spin-outs from that research center, perhaps.
Yeah, this was designed to be a sort of an early drug research center. So not the sort of later stage clinical development, but the early stage sort of drug discovery type of investment. It's also the case that it's not just that Merck are not going to invest new money in this new plant. They're going to withdraw their research labs from the Crick Institute in London as well. So, this is a damaging decision, but it's an own goal. It's an own goal whose sort of gestation really is the government's policy, or through the NHS and through NICE, on drug pricing.
Now, does this kind of news change your bullish view on the UK?
No.
And if not, why do you remain so confident?
No, it doesn't. It doesn't. This won't have an impact in the short term on the economy. This won't impact my near-term economic growth expectations, and indeed my medium-term growth expectations. I'm when I peer forward into the future, both for the remainder of this year, next year, and the year after, I would argue that the fact that Merck, for example, or even AstraZeneca are not going to invest in the UK's drug technology infrastructure will have zero effect on that view. But what it will do is impact the longer term growth expectations. And that's what I'm going to write about. And this specifically speaks to one of the concerns I have. There are others about the long term growth picture in the UK. And the UK's energy policy is another impediment that I think needs to be corrected if we are going to be able to deliver the longer term growth aspirations.
Rachel Reeves has said she'll take out regulators. Is deregulation the right medicine for the UK?
Absolutely, yes. The UK economy is over-regulated and suffers from poor regulation. It also suffers from regulatory overreach as well in financial services, in every single sphere of the economy. We are burdened with ludicrous regulation, which throttles the economy. Now, companies, businesses, commerce adapts and survives despite bad regulation and over-regulation. Companies are very adept at sort of adapting and surviving in an environment where regulation is a significant impediment to delivering better outcomes. But ultimately, it is like a way anchor on the economy, and it does throttle, it does stifle innovation, entrepreneurialism. It stifles all sorts of things that I haven't got time here to go through. But it's obvious that excessive regulation causes damage and harm and waste, and it is one of the explanatory factors for the UK's poor performance on productivity. Now, I've heard many governments talk about the bonfire of regulation, etc. And every year that goes by, we seem to get more of it, not less. So I'm not sure. I'm not doubting Rachel Reeves' ambition. What I'm doubting is her ability to actually deliver that mandate. I think what is required to deliver a reining back of regulation in the UK economy, alongside a reining back of the establishment control over enterprise, over parliament, over all sorts of things, is a much more fundamental attack on these, frankly, unaccountable bodies which control our lives. And that requires more than a chancellor to commit to deregulation. It requires a very strong administration's political commitment to do that. And I don't see that in this administration.
Now, moving to China. We spoke about China and stimulus packages previously, but it looks like we now have some idea of what shape that's going to take. And the Chinese government is preparing to tackle the backlog of unpaid bills by local governments to the private sector, which reportedly sum to over $1 trillion. Is that part of the stimulus package that you've talked about previously? And What sort of impact could something like this have?
Yes, it is. It is part of the stimulus package I talked about earlier. Uh, this sort of action was mooted nearly a year ago, so it's taken a while to get through the system. But this, along with other measures, was talked about right at the start of the sort of the stimulus debate that was first sort of announced really in September last year. This is an important move. There are hundreds of billions, maybe even it's hard to put a number on it, but the local government have been a very bad payer to Chinese industry, and it's created problems in the economy. I think those problems are now being recognized, and maybe this will be an important step forward in solving this particular issue. But it's all in and of itself, it's not going to solve all of the problems that the Chinese economy faces, but it is one more of the challenges that the Chinese government has committed to solving, and it's good news.
I presume it's potentially good news for those private businesses that have contracts with those local governments, and it should, you should see that cash, I guess, return to those companies, and I guess the shareholders should see the benefit.
Yeah, as everybody who's been in business knows, typically what causes problems for businesses is cash flow. And if you've got lots of local government contracts and you're just not getting paid, and you're funding those invoices, for months and months and months, even a year or more, then that's going to be a massive constraint on your ability to grow your business. You might even imperil your financial survival. So, this is a really, really important point. Local government needs to pay its bills and pay them quickly. And this is an important initiative.
While we're on the subject of Asia, TSMC just reported a 34% rise in its August revenue, which is way ahead of expectations. TSMC, of course, is NVIDIA's main chip maker and one of the biggest beneficiaries of the AI boom so far. What does it tell you, Neil, about the durability of demand for AI products?
This is just another sort of news item or data point that I think highlights what I've been saying about the semiconductor industry and about the AI the AI industrial revolution. There is huge momentum behind it. TSMC is a $1.4 trillion company. It's one of the top 10 largest companies in the world. I think it's now moving up, actually. It's got 65% market share of the global foundry business. It's a hugely important business globally for the semiconductor industry, which, as everybody knows, is pivotally important to pretty much every single industry globally. So it's a very, very crucial business. And it's growing at something like 37% year on year, year to date. It's an astonishing rate of growth for such a big business that is so fundamentally important to the global industry that it serves. So it's just symptomatic of really two things that I've been mentioning and that are important factors behind some of the company selections in the strategies, which is that the semiconductor industry is recovering. There's strong growth and demand in the semiconductor industry, and part of that is driven by the very, very strong investment that's going on in the AI industrial revolution.
And I guess another sign of that is Larry Ellison, Oracle's co-founder, who saw his net worth increase by over $100 billion in one trading session, one day, which I think is the largest single-day wealth gain ever recorded. So Oracle's share price, shot up more than 40% based on its revenue or its earnings call, which strangely was a revenue miss, but presumably people were excited about the forecasts. What do you make of it, and what does it say?
Yeah, I think it's symptomatic of the excitement in markets around the whole AI industrial revolution. Oracle has traditionally been a very software-focused business, and it's pivoted to really serving the AI industrial revolution by through cloud computing and building data centers and offering cloud infrastructure to people who or to businesses who need it, and there are many, and they're growing demands for this sort of service. So it wasn't the results themselves that got the share price up. It was the order backlog in its cloud computing business that drove the excitement. And this was an extraordinary gain for such a big business. And I think it meant that Larry Ellison briefly was the richest man in the world, and he overtook Elon Musk. But anyway, that's all sort of interesting, but slightly beside the point. The point is that the excitement with Oracle is driven by the excitement about the backlog in its data center business, its cloud computing business. This is just another example of the very important, huge AI industrial revolution, which is impacting the global economy, the US economy in particular, and of course a number of the largest tech companies in the US.
If the heat comes out of that AI boom, what does it mean for the valuations of these types of businesses?
Well, at the moment, there's a huge level of excitement here. Investors are excited by the headline numbers. As I've argued consistently over the last year, 2 years, it's not at all clear what the returns on investment in AI will look like.
In AI itself, I mean, it's pretty clear for businesses like Oracle what their return is, because they're, people are paying them to build them data centers, I guess. But you're talking specifically about the actual application of AI into business.
Yeah. The returns on utilizing AI in a business. What will those be? I don't know. Lots of the backlog, I think the $450 billion of order backlog that Oracle reported, that's not going to be able to be delivered overnight. That's going to take years to deliver, and of course does require, in order for it to be delivered, it requires construction, it requires data centers, it requires water, it requires power. All of these things, I believe, are going to be the constraints on the ability to deliver this sort of astronomical rate of growth and scale of investment. So I'm not saying that there's certainty attaching to the delivery of this order book on the timescale that the analysts are predicting. There are lots and lots of sort of other real world constraints on these businesses' ability to deliver these exciting sort of headline numbers. And I'm still very concerned at the moment. I'm still doubtful about, or ignorant, frankly, of what the returns on this investment will look like for many of the companies who are building these large language models and who are deploying them. There's huge uncertainty, but where there are pockets of certainty around the ability of businesses to provide what I've described as the picks and shovels to this industrial revolution, I think that's where there's great opportunity, and that's what I've tried to do in reflecting those picks and shovel suppliers to the AI industrial revolution in the W4 strategies.
It's a particularly interesting gold rush that we're seeing. I think it's definitely interesting to watch. I think that's all for this week's episode. Neil, as always, thank you for your insights, and thank you to everyone for listening. If you are a W4.0 member, you can send in a question for next week's episode. If you would like to do that, please feel free. We'd love to hear your questions. But until then, take care.